Hi, this is Moses Goldman. Welcome to my video. And in today's video, we're going to talk about how smart money trades in the stock market. How smart money trades in the stock market. As you can see here on the screen, there is a whole world of difference when it comes to how smart money buys stocks or options, or how smart money trades in the stock market, and how average money trades in a stock market is totally different. I'm going to explain it. So this is a video on how to trade stocks for beginners. How to trade stocks for beginners. All right? All right, so let's go. So as you can see here, smart money, when they are about to buy a stock, they rather buy options in the stock. That's number one here. You see that they buy options in the stock. They accumulate a position, or they build a position by first buying options in that stock. Let's say they want to buy $1 million of Tesla stock. They will start by buying, let's say, $20,000 or $30,000 of Tesla stock. Let's say $100,000 of Tesla stock. All right. And then they will buy $100,000 of Tesla options instead of the stock. They listen carefully. They do not buy the stock itself yet. They buy the option. They put one foot in the water. They test the waters by buying the options first. On top of that, smart money will hedge with put options. They're going to buy insurance on their shares, or on their stock, or on their options with put options, so that if something happens to the stock, they will get insurance payment, or they will be compensated one way or the other. So they first they buy options in the stock. Second, they hedge with put options for insurance, for safety, protect the downside. And then the third thing that they will do is that they exercise the options to acquire the stock. So they don't just buy the stock itself, they exercise options to acquire the stock. All right, so that's a big difference between how smart money buys a stock and how average money buys a stock. So let's see, on the left here, you can see how average money buys a stock. They average money goes in headlong and just dives in headlong, boom, like that, and buys the stock. They buy the stock only. No hedging, they don't hedge it. There is no insurance, there's nothing. They don't buy options, they just straight away buy the stock. Boom. And usually what happens is that after they buy the stocks, because they usually will buy the stock at the high, at the high level, when the stock has gone so high that the only way it has is to come down. The only way to go is for the stock to come down. So let's say they buy Tesla, $100,000 of Tesla stock. They just buy the stock right away, usually at a high point when the stock has gone so high. And the moment they buy, then the stock, after a little while, the stock begins to plunge, begins to go down, begins to go down. They don't have any insurance, they don't have any options, they don't have any put options to protect the downsides. Nothing. And usually what happens is that the moment after they buy the stock, they put all their capital in the stock begins to plunge because they bought it at the highest level anyway. So the stock begins to plunge, and then they panic, and then they sell, big loss for big loss. See? So that is how average money invests, or that's how average money buys stocks. They buy the stock itself, usually at the high point when the stock is overbought and it's about to plunge. That's when they buy it. And then when they buy it, they don't have any protection. They don't have any put options. They don't have any insurance. They don't have any hedging in the stock. So the stock begins to plunge, and then they don't have the patience to hold. And so they panic, and then they sell at a huge loss. So do you wonder why usually average people don't make money in the stock market? This is the difference. There's a huge difference.